Good afternoon and welcome to Boom Market Stock Show. This is your host Rian Hobson, and we have another red hot inflation number that actually came out of the United States. Actually, the CPI number for the United States came out at 7.5%. Forecasters have it at about 7%. Some have it at 7.1%. It came out 7.5%. It totally surprised the market. Dollar is moving very strong. Also, the equity markets are starting to go down. I think they will have a difficult time of going up. I doubt actually the equity market will recover, especially your NASDAQ and your Dow Jones, and even stocks around the world, equities around the world. I doubt they're going to come up. Gold is also losing steam after they had actually a very good run, because that is now all the expectations of a very strong dollar that will come forward. Because the market is now really anticipating now that the Federal Reserve will start to move interest rate. The problem with the Federal Reserve, they are behind the curve. Not even behind the curve. They're way behind the curve. They were supposed to actually to stop basically all the printing that's going on. The thing is, the Federal Reserve is still printing money, and the inflation is entirely out of actually of the mandate of the Federal Reserve. Inflation is 7.5. They actually looking at a 2% inflation rate, and inflation is sitting at 7.5%. Core CPI is sitting at 6%. That number is very strong, and I expect actually a very strong dollar actually to continue, not just for today. I think this could be actually for tomorrow. But the big story that I actually want to tell you guys is actually the Bank of America is predicting 7 rate hikes just for this year. 7 rate hikes just for this year. Please don't forget to subscribe to my YouTube page, and please drop your comments or questions regarding the trading story that's going on today. Because look, it's all dollar. The bond yields is actually screaming. It was the last time I checked, it was sitting at 1.98. It's close to 2%. If that is the case, if the bond market, or I would say the bond yields, if that is actually reaching 2%, you can assure yourself that that will literally cripple basically the commodities and also your NASDAQ. Because there's actually a very strong link between the bond yields and the NASDAQ. The moment the bond yields are going out of control, that is where the NASDAQ is going out, because it's actually people moving out of the NASDAQ, because those guys actually borrow quite a lot of money, and the yield is actually at 2%. So that will mean that they have to pay more for borrowing. But the thing is, the Bank of America is actually predicting 7 rate hikes this year. And please don't forget, they also said that there might be a 0.5% in March that the Federal Reserve will actually lift up the interest rates. And I think that's why the dollar is actually moving so strong, because the Federal Reserve need to move fast. 1, they might hike with a 0.5%, and 2, they might stop entirely the QE program, because you can't just print money and you have a very hot inflation. I mean, the US inflation is higher than a third world countries like South Africa's inflation. Can you imagine that? And that is actually now at 7.5%. So the reason why the dollar is going up, that has all to do with the expectation of what's going to happen with the Federal Reserve. That is now in March. And I think Jerome Powell don't have a choice, but they have to raise the interest rate with 0.5%, or just raise it up with a 0.75%. Because they are basically late, and now they have to ram up the interest rates, and that could cause actually the equity market to entirely collapse. Now, I'll just actually show you a few articles that I actually were going through. This was actually an article that was from Reuters, where they actually said the Bank of America says it sees 7 rate hikes just for this year. 7 rate hikes. And then on top of that, this was one from CNBC. And this is what fear of a 50 basis point federal hike say about the future of the stock volatility. Those are the 2 things that I actually came across, that it looks highly possible that the Federal Reserve will lift up with a 0.5%. And the market, from today, they're going to start to price in that by ramping up their trades for dollars, because they need to lift up the interest rates. They don't have much of a choice. The thing is, they need to stop also QE. That is the other thing. Once the Federal Reserve stop QE, and once the Federal Reserve also rate with the 50 basis points, the dollar will actually fly. The thing is, for a lot of traders, if you are opening up the trade when, for example, on the day of trade or of the interest rate decision, I think you might be too late. The thing is, you need to jump in now, because the expectation is now that the Federal Reserve needs to hike, and hike quicker. obviously, when the day comes when the Federal Reserve is actually pronouncing that they're lifting up the interest rates, then you need to look at the forward guidance of what will come afterwards. Will they be aggressive? But even with the 0.5%, I think the Federal Reserve will be basically too late, because the thing is, they still actually printing money. That needs to get out of the way. They need to stop printing money. They need to basically, also the government of the United States, and this is across the world, they need to stop this mongering of this virus. They need to stop that as well. If that doesn't happen, I don't see what the Federal Reserve can do much to drop actually the inflation if the virus story doesn't come to an end. Because the thing is, the people needs to get to work. If you put mandates on for people that needs to work, then you will just create higher wages, higher inflation, people are not working, and you will get bottlenecks on top of that. If they don't sort out those mandates so that people can get to work, get production up, then you will get inflation lower. But if they don't do that, the Federal Reserve alone can't solve that issue. And I must say, I said this last year already, that Jerome Powell is messing this whole story up. And I think he is way too late. Unless he come up with a story with a 1%, 0.5% of a 0.75% interest rate hike, I think that will be doing. But my personal advice to you on the trading platform is hammer the dollar, because I think the dollar will go strong, because the market is going to price in now. The Federal Reserve will actually go with a 0.5% off, or with a 0.5%, or maybe something with a I don't know, maybe with a 1%. Maybe inflation rates is so high. Yes, it is high, and it will be more painful actually, because now you have to live, they need to lift up the interest rates as well. That makes it even worse, because now you need to pay more for your mortgage, your car, and your credit card, and those stuff. On top of that, you have high inflation. It will be a double whammy. But thanks a lot for the comment, Joe. I really, really appreciate it. Bitcoin down, that is the story also. Bitcoin always go down because Bitcoin was more pumped up with actually printing of money. That was now through the pandemic, where the Federal Reserve was pushing money into the system. A lot of people moved to Bitcoin. Sad thing is, Bitcoin is actually losing value. But I will not say it's the end for Bitcoin, because there is still a lot of potential for Bitcoin to go up. But the inflation story is totally out of control. The main thing that is actually very disappointing is actually gold. Gold is normally seen as the best hedge for inflation, but gold is going down because they expect the Federal Reserve to be rapid when it comes to the interest rates that is coming now in March. So please, traders, on my personal side, I would say it looks for me like $1 a day, and that can continue also tomorrow. On your equity side, I doubt the Dow Jones and the NASDAQ will go up because that bond yields is too high. I think the NASDAQ will go down, the Dow Jones will go down, because the bond yields are going up and the market is preparing for the Federal Reserve to be aggressive. If they're not aggressive in March, well, I don't know. But for now, I think the market is pricing in that the Federal Reserve will come aggressively, not just for now, but also for this whole entire year. I'm with the dollar bulls. Commodities on the other side. Yesterday, there was actually a drawdown of 4.8 million barrels inventories in the United States. That means oil prices are normally going up. I will actually stay away with oil, but when the dollar is strong, that is where all commodities are going down, especially gold as well. I hope you guys enjoyed today's show. Thanks a lot, Joe, for the comments. And then I will see you guys again at the same time. But for me, it will be all dollar day for me. Okay, I'll see you guys. See you guys tomorrow at 4 o'clock. Bye-bye.